I want you to avoid those RMD penalties, the 50% penalty. Here's 5 more tips how to avoid those most common RMD mistakes. All right, so last week we went over 5 common RMD mistakes that people are making, and we want to help you avoid those 50% penalties, one of the highest penalties out there. Today I want to go over 5 more tips. So we're going to go over 10 tips total. Here's part 2, how to avoid those most common RMD mistakes. Number 6 here, taking an RMD, required minimum distribution, from your spouse's account. I've had people come over on board here in the last few years, and it's happened more than you would want to believe. One of my clients, very intelligent individual, as they were coming on board, it was fall of the year, kind of October-ish, and I just said, I just want to make sure you took your RMDs out of your IRAs here, Bill. And he said, I did. He said, I took my RMDs from this IRA for all of my IRAs. I said, perfect. How about for your wife's? Of her IRAs, which of her IRAs did the RMDs come out? And he said, I took her RMDs out of my IRAs, not hers. And I said, Bill, you can't do that. And he goes, what do you mean? I took the right amount out. I said, but you can't take a required minimum distribution for your spouse's IRA out of your IRA. It's called an individual retirement account. I says, if the IRS catches up that you did that, that's a 50% penalty. So we had to go back and retake those out, write a please forgive me letter to the IRS. So I just want you to understand, you can't take your required minimum distributions out of a different account, a different spouse's account, okay? Let's go to number 7. Taking an excess RMD one year, thinking it's going to cover your RMD for the following year. So let's just say you're 72 and your RMDs are $10,000 last year, or when you were 72, and you took out $20,000. And so when RMDs are due this next year, you said, well, I already took out an extra 10 grand. I don't have to take out RMDs this year, or I just take $10,000 less. It doesn't work that way. You cannot take out RMDs for multiple years in one year. It's by the year. So if your RMDs are 10 grand and you took out 20, that's just taxable income of 20,000. And because they look at December 31st balance to determine what your RMD is. So they could care less if you took out extra or not. Or if you took out extra before your RMD years and you said, now I'm taking all these withdrawals in these earlier years so I don't have to take my RMDs. It just doesn't work that way. You have to take them by year, and they use that December 31st balance to determine what your RMDs are for the next year, okay? Roth conversions are not allowed on your RMDs. I've had a lot of people tell me, says, I don't need the money when I have to take my RMDs, so since I have to pay taxes, I'm going to just put that money into my Roth account, since that's what Roths are. You pay your taxes and it grows tax-free. The IRS will not allow you to do that. You cannot take your IRA RMDs and put that after-tax money into your Roth account. It's not allowed. So what you can do, though, is you can do Roth conversions after your RMD is met. That's what the IRS states. As long as you met your RMD first, that has to come up first, then you can do Roth conversions after that. You just cannot use the money after tax from your IRAs to fund your Roth accounts. It has to, conversions have to be done secondly. Number 9, it gets to be a little tricky. So taking an RMD after you had an employer sponsor plan. So here's the key on this one. If you have a 401k or 403b or any employer sponsor plan really, and let's just say you're 71, okay? And what happens, remember, they look at December 31st balance of the year before you're 72. So if you had money at the end of 2021 and it was a 401k and you're 71 last year, which means you're 72 in the year 2022, and you left it as a 401k, you must take your RMD from that 401k first before you roll it to an IRA. Let me repeat that. You must take your RMDs out of your employer sponsor plan before you roll it to an IRA, because it was already classified December 31st to the IRS as an employer sponsor plan. So if you roll that money to an IRA in 2022, before you take your RMDs out, When you take your RMDs out of an IRA, it wasn't an IRA last year, so the IRS will penalize you for taking it out of an IRA, again, because it wasn't an IRA last year. You must take your RMD from the employer-sponsored plan before it's rolled over to an IRA, otherwise you can have that 50% penalty. It's a little tricky, but you should be rolling that money first before December 31st of the year you're 71. And here's the last tip, number 10, tying up your IRAs in illiquid accounts. Never been a fan of this. Yeah, we're talking about illiquid accounts like real estate, REITs, real estate investment trusts, like these non-traded REITs. I've had people that have come into our office and their IRAs, we didn't offer these to them, but their IRAs were tied up in these accounts. And when they're 72, your RMD years or older, what are you going to do? Hopefully you have other IRAs that you could take the RMDs from, because if you can't sell that real estate to get the RMDs out, you have a 50% penalty. Or these real estate investment trusts that are illiquid, that they tell you when you can get your money out. And if you can't get the money out, where are you going to take that out? If all your IRAs are in these illiquid accounts and you can't liquidate them, you're going to have penalties. I was even on the phone with a client of mine a couple of years ago. She had one of these non-tradable REITs and her IRA was in it, and she was RMD age, and they said she couldn't get money out at all that year. I said, why would anybody have an IRA in one of these non-tradable REITs? This is what I'm asking the customer service representative with my client on the phone when she can't take money out. Why would you do that? She goes, I don't understand why they do that, ma'am, or sir, and talking to my client as well as myself. She said, I don't know why they do that. So I'm not a fan of that. I even had another client who came in who put a bunch of money in some commercial real estate. And they said this real estate was supposed to be sold 2 years ago. Something fell through and it's not be able to get sold. And they were kind of in a bind because they have to take money out. Otherwise you'd be penalized. So I know these might not be as common as other ones, these last 5 tips, but these are things to be aware of because I don't want you to pay that penalty. Again, one of the biggest penalties out there in the IRS tax code, a 50% penalty. So with these 10 tips, hopefully you have some good information how to avoid those mistakes. If you have questions, send us an email, send us a message. Click that like and subscribe. We're going to get some more good content out to you on retirement Reality on Demand.